Well, we are officially in a bear market, and one fund that has always received criticism about how it's never been through a bear market is the fund QYLD. Well, guess what? We're now in a bear market officially, and we can put QYLD up to the test. And that is exactly what we're going to talk about in today's video. QYLD currently pays 11 to 12% dividend yield, and that's pretty darn attractive to most income investors. It's grown actually from 3.8 billion under assets to today's 5.8 billion net assets due to investors piling in on this fund to take advantage of the monthly income. And right now you get anywhere from about 17 cents to 20 cents per share every single month. It's kind of nice to get paid every single month by investing into a fund, is it not? But the issue kind of comes down to the price, right? A lot of people are wondering, well, what's the deal with the price? This fund isn't about the price. This fund is about the monthly distributions. So in this video today, what we're going to talk about is which investors QYLD actually benefits, how QYLD is actually going to hold up in this bear market, and we're going to check QYLD against QQQ and even against the S&P 500 to see how it's actually doing in the bear market that is 2022. You ready to get started? Don't be dumb. Tap the thumb. Let's get right to it. So how they actually pay out their monthly distributions is they write covered call options. It's an options trading strategy against the NASDAQ 100. It's the top 100 non-financial companies that are listed in the NASDAQ stock exchange. Now, if you want more detail on how that money every month is actually paid out and how that all works, you got to check out my QYLD tax video that I'll link down in the description below as well as up above, so you can check that video out after this one. Because if they don't make money on their options premiums, they pay you a different way. And yes, they've been paying consistently and very strongly since they first launched in 2013. But some of that comes with some tax liability. You need to make sure you check that out before you invest in this particular fund. So who actually benefits from QYLD? Well, if you're expecting some growth on a QYLD, this really isn't your jam. QYLD is an income investor's dream. This is about somebody that's focused on income distributions on a regular basis, on a somewhat reliable basis, and this is what QYLD is all about. And that's what I was mentioning earlier with the price. As we see it over here today on Seeking Alpha at $17.77 per share. If you look back here, it's dropped 20% over the last year, and if you go over the last 5 years, it's down 11.24%. You can see a little bit later, this past 2021, it was at $22.90 a share, of course down to $17.77, but it's not about the price. The price will remain relatively flat, right around the 20s or the 15s or so, because of how this fund actually operates on its covered call options writing strategies. And you know, it's interesting to actually see it in this bear market. This isn't a correction, this isn't a flash crash like back in the pandemic. This is truly a bear market, and it's going to be interesting to see how QYLD actually holds up. Now, if you're an income investor, this one's going to be super interesting for you to understand and how it weighs itself over the next couple months, especially if we continue from a bear market into a long-standing recession that some investors are calling for. How is QYLD actually going to hold up in this market? And this is really interesting. I put this against our portfolio visualizer, as I always like to do. So if we look at this, I put $10,000 into QYLD, and I just kind of put it in, I set it, and I forget it. And I don't reinvest any of the dividends. Absolutely not. So what happens from the time that QYLD launched until today? What does that look like? Well, if we come down here, here's the answer. Our initial balance of $10,000 without dividends reinvested would only be worth $6,840 today. What an absolute terrible thing, right? But remember, all that time you've been receiving dividends. So technically you're getting the payoff. And because you were not reinvesting the dividends, you were getting that cash back. So what did you do with that cash? I don't know. Did you invest it into other stocks, or did you cash it out and use it for some other fun money or whatever else you'd want to do with it? And that's the whole reason that this is also interesting. This will draw down on your balance when they do return of capital. They don't always make money on the covered call options writing strategies that they do. Let's face it, especially in a bear market, it's going to be hard to do that. And then what happens? Well, then they have a decision they have to make. And that's called return of capital, where they're taking your money and returning it to you based on a monthly distribution, which is also why we see this go from 10,000 down to 6,840 on top of the bear market. Again, you want more info on that whole return of capital, you gotta check out that tax video after this one. But then look at our annual returns. You can see 2022 is the first test of what is actually gonna happen with this particular fund, down 16%. Otherwise, it's been up. Yes, even in 2020, it was up 7.68% at the end of the year. But what happens if you reinvest the dividends? So we just looked at this, went from 10,000 to 6,840. If you would have reinvested the dividends, it's a little bit of a different story if you compare apples to apples. Your 10,000 would actually be worth $16,436 today. So even amongst all the other pain and agony, it has performed at least okay, given back 6.02% since its initial launch. But it makes you wonder, what about QQQ, which also tracks the NASDAQ 100 index, but that particular fund is not based on income investors. That is based on growth. And I have a video on QQQ if you want to learn more about that one. I'll also link it down below if you want to check that one out too. But if you're focused on growth, that might be your jam. If you're focused on income, QYLD might be your jam. It's all up to you, and you still got to do your own research. None of this video today is financial advice. But let's compare them. If we did $10,000 on QYLD and another $10,000 on QQQ, which one is doing better in 2022? So I'm actually going to use 2021 to 2022, $10,000. We're going to reinvest the dividends, because why not? QYLD versus QQQ. Let's see what's happening. So I'm going to analyze the portfolios and check this out. So your $10,000 on QQQ landing you at $9,234. It's still down because we're only looking at 1 year. But then QQQ is down even more, $10,000 to $9,005, drawing down 6.75%. QQQ is actually down lower than QYLD with the dividends reinvested. We're looking at QYLD and we're like, okay, if you look at the year to date, we're down 20.28% from January all the way through to July. And then you look at QQQ and it's down 26%. So QYLD is actually beating the NASDAQ index. I mean, that is pretty good comparatively to our benchmark, which is QQQ. But let's compare QYLD over here at this nice little 20.28% down for 2022 to the S&P 500, another great index. And we'll use SPY, S-P-Y, as our benchmark for the S&P 500. 20.28% down compared to 18.64%. Now that is super interesting, isn't it? Because here we are with the S&P falling down as much as it has. QYLD, even though it is falling down 2 percentage points lower, isn't as bad as we thought it would be. And that was a lot of the criticism of QYLD in the early days, saying, hey, this thing hasn't been through the bear market. How are we going to know what it does when we approach said bear market? Well, 2022, as sad as it is, has blessed us with this opportunity to really look at QYLD a whole different way. Now, somebody else asked me, well, wait a minute, what if the reverse happens and all of a sudden the stock market recovers and shoots to the moon? Will they be able to keep up with all of this stuff? Well, remember, it is a covered call writing option strategy. If they can get some calls high enough, there could be some opportunities for some premiums. But right now, and call me bearish if you want, or pessimistic, even though I'm not really trying to be pessimistic, I really don't see the stock market having a sudden surge and recovering to like an all-time high right away. I think we're actually going to see a recovery that is a little bit more slow and steady than we have in the past. Remember the coronavirus pandemic crash that happened in March 2020? I mean, it went boom, it just fell off of a cliff. And then we all of a sudden surged dramatically. And a lot of that had to do, as much as you don't want to maybe admit it, let's be honest with ourselves, because of the stimulus checks, because there was so much money being pushed into the market by government sending all this extra money and help and support. It raised up the stock market. And yes, the good thing is we got back on track very quickly from a very devastating situation, but it also, surged us quite significantly. I don't see that happening again. In fact, right now, the Fed is really focused on dialing back the inflation with a lot of interest rates adjustments. So any type of recovery, I think, will be great, but a little bit more slow and steady than we have seen in 2020 and 2021. So I'm still excited about the fact that QYLD is that income investor's interesting opportunity. Again, it is a distribution, not technically a dividend, because a dividend is based on a company's profit paid out to you, the investor, whereas QYLD is an interesting fund that's based on options writing strategies, and therefore they give you a distribution based on the income that they generate through that particular strategy. What are your thoughts on QYLD? Comment down below and let me know. Check out this video next. We'll see you on the next video.